Listen carefully, because what I'm about to tell you could be the difference between your family keeping everything you worked your whole life to build, or watching nearly half of it disappear into the hands of the Canada Revenue Agency the moment your spouse takes their last breath. This is not fear-mongering. This is not exaggeration. This is the cold reality of how the Canadian tax system actually works when one partner dies. And the worst part is that most Canadian families have absolutely no idea this is coming until the tax bill lands on their kitchen table months after the funeral. You see, the CRA does not treat death the way you think it does. The moment your spouse passes away, a silent financial event is triggered behind the scenes. And if you have not moved or restructured the right four assets before that moment, you could be looking at losing 30, 40, even 50% of your life savings to taxes that were completely avoidable. Families across Canada are being financially destroyed every single year by this exact trap. And the saddest part is that nobody warned them. Nobody sat them down and explained that timing decides everything. That one signature on the wrong document or one delay in restructuring ownership can cost their children hundreds of thousands of dollars in inheritance. So before you assume that everything will just pass smoothly to your spouse or your kids, you need to understand what is really happening behind the curtain, because the CRA has rules built into the system that quietly revalue your assets, reset your tax exposure, and turn your retirement nest egg into a taxable event the day your partner dies. And in 2026, with new enforcement and tighter estate scrutiny, these rules are hitting Canadian families harder than ever before. Here's the hidden rule almost no one talks about until it is too late. In Canada, when a person passes away, the CRA applies something called the deemed disposition rule. What that means in plain English is that the government pretends you sold every single one of your assets at fair market value on the day of death, even if nothing was actually sold, even if nothing changed hands, even if the family is still living in the home or holding the investments. The tax system automatically triggers a reset event, and your assets are silently revalued at market price, which means any capital gains that built up over the last 20, 30, or 40 years suddenly become taxable in a single year. Think about that for a moment. A cottage bought in 1985 for $60,000 that is now worth $600,000 has more than $500,000 of gain sitting inside it, and the CRA wants its share of that gain the moment the owner dies. The same thing happens to investment accounts, to rental properties, to business shares, to almost everything you own outside of your principal residence and your registered accounts. Now, there is one big exception that protects many couples in the short term, and that is the spousal rollover, which lets assets transfer to a surviving spouse without triggering immediate tax. But here is the trap that most families never see coming. That rollover only delays the tax. It does not erase it. The moment the second spouse passes away, every single deferred tax bill comes due at once. And if the family has not planned properly, the children are left scrambling to pay a massive tax obligation they never knew existed. Most families only discover this when it is already too late, when the estate lawyer sits them down and explains why they owe the government $200,000 or $300,000 before anyone inherits a single penny. Let me paint you a picture of how this actually plays out in real Canadian homes, because numbers on a page do not capture the heartbreak of what happens when this rule hits a family that was not ready. Picture a retired couple in Ontario, both in their late 70s, who spent 40 years paying off their home, building a modest RRSP, and saving inside their TFSAs. They have a rental property they bought decades ago that helped fund their retirement, and they own a small cottage up north where the grandchildren spend every summer. Life is good, life is stable, and then one morning the husband does not wake up. Within weeks, the wife is dealing with grief, paperwork, and a lawyer asking questions she has no answers to. At first, everything seems fine because the spousal rollover protects her, the assets transfer to her name, and she thinks the storm has passed. But 3 years later, when she passes away too, the children inherit a nightmare. The rental property, which has appreciated by $400,000, triggers a massive capital gains tax. The cottage, which the family assumed would just pass down through the generations, suddenly carries a tax bill of over $100,000 because it is not a principal residence. The RRSP, which had grown to nearly $600,000, gets fully collapsed into taxable income in the year of death, pushing the estate into the highest tax bracket and wiping out almost half of it instantly. The children are now forced to sell the cottage, the very place where they made their childhood memories, just to pay the CRA. This is not a rare story. This is happening to Canadian families every single week, and it is happening because nobody told them about the 4 assets that needed to be restructured before that final goodbye. Pensions, real estate beyond the family home, registered accounts like RRSPs and RRFs, and non-registered investments all carry hidden tax landmines that explode the moment the wrong death happens at the wrong time. Now, here is where most Canadians get it completely wrong, and this is the part that costs families the most money. The biggest mistake is assuming that joint ownership automatically solves everything. Many seniors add their adult children to the title of their home or their bank accounts, thinking it will make things easier when they pass. But what they do not realize is that adding a child to ownership can actually trigger an immediate partial disposition for tax purposes, can expose the asset to that child's creditors, can create family disputes, and can even disqualify the principal residence exemption on part of the property. The second huge mistake is delaying estate planning until someone is already sick. Once a person is diagnosed with a serious illness or loses mental capacity, the window to restructure ownership, set up trusts, or transfer assets strategically slams shut, and the family is left with whatever messy structure existed at that moment. The third mistake is not understanding that RRSPs and RRIFs are tax bombs. People treat them like savings accounts, but when the second spouse dies, the entire remaining balance is added to income in a single tax year, which can push the estate into a tax rate of over 50%. The fourth mistake is ignoring the difference between assets that qualify for the principal residence exemption and assets that do not. A cottage, a rental, a second home, a piece of land, all of these are sitting there quietly accumulating taxable gains, and the CRA does not warn you about this in advance. They simply collect when the time comes. This is where most Canadians lose the most money, not because they did anything illegal, not because they were careless with their finances, but because they trusted that the system would be fair, and the system was never designed to be fair, it was designed to collect. So what can you actually do to protect your family before that moment arrives? Because knowing the problem is only half the battle. The first protective action is to sit down and review the ownership structure of every single asset you own, because how something is titled often matters more than what it is worth. Property held jointly with right of survivorship, property held as tenants in common, property held inside a trust, and property held individually all behave completely differently when death occurs, and choosing the wrong structure can cost your family more than any investment mistake ever could. The second action is to start estate planning long before you think you need to, ideally in your 50s or 60s, because the strategies that save the most money take years to set up properly. Things like spousal trusts, alter ego trusts, joint partner trusts, and properly structured insurance policies can shield enormous amounts of wealth from the CRA, but only if they are in place well before any health issue arises. The third action is to understand your tax exposure today, not after someone passes. Sit down with a qualified tax professional or estate planner and ask them to run the numbers on what your family would owe if both spouses died this year. The answer will shock you, but that shock is exactly what motivates the right action. The fourth action is to consider strategic gifting during your lifetime, because in some cases, transferring assets while you are alive, even with the immediate tax cost, ends up saving the family far more in the long run than letting everything accumulate until death. This is not about avoiding tax, it is about preventing unnecessary loss. It is about making sure that the money you worked your entire life to earn actually reaches the people you love instead of disappearing into government coffers. And here is the final warning you absolutely need to hear before you close this video and go back to your day. The CRA rules around estate transfers, deemed dispositions, and inheritance taxation are not static. They are constantly evolving, and the direction they are moving in is not friendly to Canadian families. Every year, new enforcement measures, tighter reporting requirements, and updated valuation methods make it harder for ordinary people to pass wealth down without massive tax consequences. Many Canadians are sitting on ticking financial time bombs right now, and they have no idea because their accountant only deals with their yearly taxes. Their financial advisor only deals with their investments, and nobody is looking at the full picture of what happens when death enters the equation. There is one more CRA rule that can actually double this tax burden in certain cases, a rule tied to the way pensions and registered accounts interact with provincial probate fees and second spouse death scenarios, and most people never see it coming until it has already drained their estate. I'm going to break that one down in the very next video, because it deserves its own deep explanation, and if you think what you just heard was alarming, the next one is going to change the way you look at every dollar in your RRSP. So before you go, leave a comment and tell me honestly, do you think Canadian families are properly informed about these rules, or is the government quietly counting on the fact that most of us will never figure it out until it is too late? Share this with someone you love, because the conversation you have today could save your family hundreds of thousands of dollars tomorrow. And in a country where the tax system never sleeps, the families that win are the ones that prepare while there is still time.